Hello and welcome to today's super packed video, which is called When is the time to buy S&P 500 crash? This is going to be a very rich presentation covering stocks, bonds, international stocks, US dollar, precious metals, oil. I will be talking copper and of course in charts as well Bitcoin. A lot of sentiment data, a lot of intermarket analysis, and much volatility and options positioning to drive correct market calls for the week ahead and for the months ahead. Because remember, we had quarterly close. So you know pretty well what I do on my site, and this week's article will be very short in the public version, so make sure to review this super extensive video. This will satisfy traders and investors alike. This is the weekly chart. I've been talking consolidation around the 200-day moving average, which during the first part of the week looked very promising. Market breadth had deteriorated. You can look at the bottom most. New highs, new lows, which had been steadily making a bearish divergence. This is mirroring the picture in the McClellan Summation Index, which I had shown you a couple of weeks ago. So we will examine how it looks currently, because this weekly chart says clearly bulls missed the opportunity to reclaim 200-day moving average and bears are in the driver's seat. McClellan Summation Index perfectly mirroring the pattern of lower highs and the rally during February that had briefly taken on those December FOMC highs, fizzling out and rolling over. There was a budding positive bullish divergence, which I did not want to mention because that would spoil what you will see further on in this video. This is very rich and dozens of charts with practical, fast conclusions. Thank you for liking this video and subscribing to the channel. Here is the daily chart. Steady deterioration Friday and no buying attempt during the day. Did we see a volume spike? Is it sign of a capitulation? Not really. 200-day moving average. Percentage of stocks trading above that, solidly below 50. This is not looking good. Same for 50-day moving average. That percentage is as well below 50. And the flashy short-term periods only reinforce the very bearish Friday's picture as seen on this hourly chart. It was clear to me within half an hour that equities are not going to even attempt a modest retracement to try to retrace at least the first Fibonacci level. Nothing like that, let alone kiss from below, as I call it, full retracement and continuing lower, which would be a great short entry point for swing trading clients. The intraday ones, they could have been riding and they were riding the bearish momentum. What was so different about Friday was that junk bonds lost their marbles. They had declined, whereas quality bonds had risen. You can see similar picture in credit default swaps, credit spreads. These are painting the picture of increasing strain, and equities are taking it on the chin. Yields picture going sideways, but taking a sharp turn south, led by the short end of the curve. This is a message of itself of strain temperature slowly rising in the financial system beyond equities. US dollar shallow retracement that was to target the 104.50 to 105.50 area that I talked about last week, precisely on Wednesday, when I called for US dollar to start rising, which would and did reinforce inflows into US equities from rest of the world, providing a cushion, providing fuel for S&P 500 to briefly reclaim and remain for good 24 hours above 200-day moving average. That effect had played out, and US dollar is as well painting a picture of caution. We will see it further on when I talk international stocks. It would be very comfortable to point the finger towards Japan. But do you see any kind of fearful rush to yen? No, not even Friday's move on this 4-hourly chart shows rising temperature, and during the last 7 days in these daily videos I had been covering the fact that Bank of Japan is desperately behind fighting inflation and keeping up the living standards of Japanese workers, because wage growth is terrible there compared to rising inflation. So it's just an euphemism about rate raising risks. They are nowhere near, and this currency chart is clearly confirming that. Your appetizer for how the sentiment in the stock market, US stocks, is shaping up. This week we had seen a mild shift towards the bullish side, meaning bearish positioning and expectations were dialed back. Given that these are data, including Friday, the level of pessimism could have and should have be even worse. Anyway, what is the conclusion of it arising from this? It's that stocks are in for a rough entry to April. I have said that they come for the generals last, and all the stock market bulls had been clearly eyeing the performance of financials, how it relates to industrials, meaning Dow Jones Industrial as well, and that not just XLI. And this is as well what has taken a clear turn towards the reverse side of things, just as junk corporate bonds did Friday. So this is something worth noticing, that you see as well the rising volume. Next two sectors are going to be real estate related. Real estate and home builders. I would have liked to see some kind of a positive turnaround in these. It would as well signify decreasing fear over the tariffs uncertainty. But you know about the Freedom Liberation Day that is coming beginning of April. The scope of reciprocal tariffs has to be worked out. China has been already slapped with 20% early February, and it's European Union's turn. So there is plenty of uncertainty still, and that charm offensive that Europe is trying is not exactly working out, in my humble opinion. So this is the picture that is showing still strain, stress and uncertainty regarding tariffs. We also know about the headline of World Trade Organization financing stop. So it just completes the picture. And this home builders chart shows that there is still somewhat more business on the downside to be done before a local bottom is reached. Because you remember me talking about a significant level that was broken and then targeting OPEX lows, which had been as well broken, meaning we go for the ultimate lows. In this downswing, it's too early to call it either a correction or a bear market. This has to prove itself. And I have been making it in one of those extensive weekend videos, which are part of the playlist. So make sure to be reviewing not just the quick daily ones, but as well the extensive, super extensive weekend ones at your convenience, because these are packed the most and readying you for the week or even weeks ahead. Such is the aim of today's video as well. So thanks again for liking it. And now let's go to those data points. Such was the key data feed Friday. PCE prices, core PCE, personal income and personal spending. That was to be having a greater effect in my mind than revised University of Michigan data. The slant is clear. Inflation is running above expectations. Personal income is rising, meaning that there is still some hot segments within the job market. However, the consumer is less willing to spend, is retrenching. Not only that, consumer is feeling less positive regarding about the future, which is an understatement if you look back to the data going all the way to not 2020 but 2022 only. And inflation expectations, forget about trueflation, this is different. This is about what the consumer expects. This is as well what is running quite high, has been revised higher. So this paints a clear picture of what the Fed is going to be facing. That's why you don't see yields going down by nearly as much as would be logical, expectable, normal, not normal, but say fitting the chain of economic dependencies during an economic soft patch. And it is worries about rising inflation, its effect on not just the job market, which is the key part of this segment of my video prepared for you, but as well of corporate earnings. Forget not that the reporting period is starting quite soon. And I have already talked tariffs. So let's stay within the job market, where we can see right now this is a remainder chart from the core PCE. It's too early to call it a resurgence in inflation, but the seeds are clearly sown. So this is something to take into account. Rising personal income revealing the status as well of the job market. You have still good participation rate, still reasonably okay. Unemployment rate and hours worked. These are the key metrics to watch together with overtime and temps for indications of recession. Personal spending, not exactly surging, guarded stance. And now finally that block of job market data. Initial jobless claims, well behaved, nothing out of the ordinary. Continuing ones, slowly rising slowly. However, it is not out of the ordinary yet. This is not yet even amber light. Non-farm payrolls. We can see a clear decrease in the jobs reported as being created with all the adjustments that Bureau of Statistics is doing. Bureau of Labor Statistics, I just shortened it. So this is still painting a picture of caution, and this will be the key data point this nearest Friday. So let's dive into what I would be watching the most. Government payrolls. Expected minus 50,000. Could be worse. Let's see about that. Private payrolls, would they surprise and come in at 130 forecasted? Remains to be seen. I'm not totally sure about this. Participation rate, you see, perfectly in line. Hourly earnings, no red light there. Either unemployment rate, I told you already, is okay, and the expectation for just 80,000 jobs being created. Headline is a really tame one. So this is already reflecting impact on job creation. You can review for yourself the Challenger job cuts. This is a survey I like the most, actually. I have as well tweeted a progress heat map during yesterday with very few hiding places. You could have seen some within healthcare, a bit within real estate, but most of it was within utilities. Otherwise, there had not been any good sector to hide yourself in during Friday. Here it is, stated very clearly on the daily performance chart. I'm not showing you this time the 5-day perspective because the risk of turn is clearly visible there, and I had made the call to clients that ever since this 5,715 futures level was broken and prices below were accepted, it's been game on. Venturing into international stocks, and the theme, it's kind of connecting to the US dollar and yields, which I had already covered. I had been clear for quite a few weeks that the US stocks will not be the only game in town, and we can see that DAX had been, after the deficit spending initiative, taking off. However, now it's in a consolidation phase because the tariffs hammer is going to be hitting. Europe will be responding, and it will bring pain to both sides as the US is seeking to reset its relations with the rest of the world on a more sustainable footing than had been the case currently for decades. So we see outperformance in European equities. Even France is mirroring that. But DAX is among the strongest, biggest, deepest European indices. So that's why I'm mentioning it. The next one to talk is, of course, China, where we can see increasing appetite, increasing inflows during this year, and it's offering an interesting tactical spot. This is a big gaps in aggregate. Mainland Chinese are more cautious regarding the outlook. However, there is no flash, no doubt and it's base building cautious. Remember, since early February, China already has those 20% tariffs, and yet Shanghai Composite is up. Hong Kong, even better picture, understandably so. This is the up, and yet it is barely correcting. So this is one of your peaks, and there are other pockets of strength within international stocks. Right now, when US equities are underperforming and Dow Jones is among the relatively better ones, the best ones among them. Volatility view. It had looked that we can be forming slowly if Friday behaves and cooperates, because the initial reaction to core PCE and personal income and personal spending had not been at all panicky. If it were cooperating, around it top could have been formed, remaining still below 20, but once 20 is broken to the upside, it always spells a kind of trouble, and that's exactly what we had seen. So let's refine this picture with my favorite volatility metric, and that's the ratio of VIX to short-term VIX. And there we can see really starting off not at all panicky, not at all bearish leaning level, meaning same expectations. However, closing, and here it looks that we are slowly in the process of making those that rounded top, and I do not expect that the mid-March highs in this ratio depicting volatility to be overcome to the upside, and this has implications for the stock market path ahead, as you can sense over the nearest, say, 5 to 10 days. Finally, an options view, which is not exactly indicating panic risk of positioning either, and the daily volume in S&P 500 fully confirmed this observation as well, meaning that Monday's morning and entry to the new week will be interesting, and you can look forward for unemployment claims, Wednesday's preview of non-farm payrolls for small companies, and the full economy data Friday. Finally, bright spots and overview of real assets and cryptos. Ever since gold woke up early Thursday, I had been telling clients that medium term trend, uptrend, is reasserting itself, and here we go, running higher. What will be my watch out for gold? And what had been its ascent fueled by? Remember that I had not been fearing Thursday's opening flush either. I will be linking to several videos during the week where I had been covering various facets as they were playing out in the market, and gold's move was one of them. So what is the driving force? It's tariffs uncertainty. Early in the week we got soothing headlines about targeted. It's turning out that it might not be just so much targeted, and there have been some calming noises from Canada as well. Let's see how this backyard plays out as well. So the risk to gold and precious metals in general would be removing the tariffs uncertainty when the picture crystallizes and is known because markets abhor nothing more than uncertainty. Silver hammered Friday following the opening bell, quite similar picture to Thursday, and for all the deterioration on Forex index and MACD histogram, this is one of the stronger charts still. Same for copper, which had suffered even a greater setback Friday. These are very interesting from the medium-term perspective, and dips within these two volatile metals are to be bought. Oil. Clients had been patiently waiting for it to be rolling over. There were signs already where I expected that late Wednesday or during Thursday, giving out resistances. Ultimately, they had been respected, and crude oil obliged by declining. And this chart is as well looking a bit spent to the upside. It's actually the shape and hourly structure is kind of reminding the S&P 500 all the way till Wednesday, including Bitcoin. How can crypto prosper when there is such fear, and it's not yet even extreme fear, hitting the markets? Long red candle. Friday, sell-off continuing. Today, and we can look forward for Monday in equities and precious metals. I hope you get the drift. Thank you for having been patient. Thank you for liking this video and subscribing to the channel, because there is so much value to derive from the daily coverage. My joint page will help you select what's right for you based on what and how you trade. I have an announcement to make, which is an additional reason to keep tomorrow's article short, but I wanted to make it up for you in this long video.